Dirty dealings, corporate battles, consumer woes. This is Evening 5. Hartalega Holdings notched a turnaround in its final quarter of FY 2024, thanks partly to a reversal of provisions that's brought the world's second-largest glove maker by volume back into the black for the full fiscal year. Its latest quarterly earnings totaled 15.12 million ringgit. Aside from the provision reversal for a foreign subsidiary in bankruptcy during the quarter, Hartalega said the preceding year's corresponding period was also dragged by an asset impairment loss of 347 million ringgit. Meanwhile, revenue climbed 2.4% year-on-year to 529.83 million ringgit due to higher average selling prices. No dividend was declared for the quarter under review. Hartalega Chief Executive Officer Kwan Moon Leong said he is confident in the sector's recovery and noted that its decision to decommission the Bestari Jaya facility has paid off as the glove maker's bottom line has improved. Looking ahead, the company will continue executing its 5-year plan to strengthen business sustainability and resilience, focusing on cost optimization and automation. For the full year, Hartalega booked earnings of 12.72 million ringgit against a net loss of 235.14 million ringgit previously. However, revenue was down 24% to 1.8 billion ringgit due to sharply lower sales volumes and a decrease in average selling prices amid soft market demand. Australian boutique fund manager North Cape Capital reportedly said a bid by major shareholders to take Malaysia Airports Holdings or MAHB private may face opposition, no thanks to the low valuation offered. North Cape owns a 1.7% stake in the airport group. According to a Bloomberg report, Ross Cameron, a portfolio manager at North Cape, said the shareholders might need to revise the offer, which he deemed opportunistic, and said there is a risk the stakeholders won't get the 90% threshold needed to delist MAHB. A Khazanah National-led group had announced an offer for shares of MAHB it doesn't already own at 11 ringgit apiece. The report noted that the move comes as revised concession terms and extended operating agreements provide better earnings visibility for MAHB. Analysts have mostly recommended that investors accept the buyout offer, with Macquarie Capital Securities analyst Maxco saying the deal is fairly valued given that MAHB's share price has advanced in the last 6 months as minority shareholders positioned early. The report went on to say that some may opt to hold out for a better price and highlighted that the $17 billion sale of Sydney Airport in 2021 was only completed after 2 previous bids were rejected. It quoted Mohit Mirpuri, a fund manager at SGMC Capital, as saying that a deal would materialize eventually, though it may just take longer than they anticipated. Petronas Dagangan or PetDag saw its first quarter FY 2024 net profit fall 25% year-on-year to 226.04 million ringgit, due mainly to higher product cost and operating expenditure. Revenue for the quarter rose 8.6% to 9.39 billion ringgit. PetDag declared an interim dividend of 18 cents per share. Reviewing its performance, it said the average oil price stood at $83.16, approximately 390 ringgit and 17 cents per barrel in the first quarter of FY 2024, a marginal 1% decrease compared to the previous quarter. Despite the market volatility, the group achieved steady revenue growth, driven by increased sales volumes and impact of promotional campaigns, a strategic focus on commercial growth in the fleet and transportation sectors, as well as a tourism-driven rebound and passenger traffic. Commenting on its prospects, PetDag said the average Brent crude oil price is forecast at $88.70 per barrel in the second quarter of FY 2024, amid ongoing OPEC OPEC+ production cuts, though a potential increase in Russian crude oil exports is expected to balance the market by boosting oil supply. It sees continued growth in its retail and commercial business segment on the back of strong domestic economic activities and the recovery of the aviation industry, while the convenience segment continues its focus to expand Cafe Mesra and Kedai Mesra offerings and campaigns during the festive season in the second quarter of FY 2024. Pos Malaysia is selling its ship chartering unit that mainly deals with bulk cargoes for 123.21 million ringgit as part of a move to shed non-core businesses. It said in an exchange filing today that the proposed sale of PNSL to SWA Shipping will also settle outstanding intra-group trading debts and advances owed to Pos Malaysia. Proceeds from the disposal are expected to strengthen its cash flow and reduce its interest expenses. Of the 123.21 million ringgit, SWA Shipping needs to pay 55.61 million ringgit for the entire equity interest in PNSL. 67.6 million ringgit is for settling the outstanding debts and advances that PNSL owes within its group of companies. The proposed disposal would allow Pos Malaysia to reposition and realign its investments into more profitable businesses with growth prospects in line with current industry trends. Pos Malaysia said it plans to allocate 92.94 million ringgit of the disposal proceeds for working capital and 27.81 million ringgit for repayment of bank borrowings, which stood at about 505 million ringgit as of December 31st, 2023. The exercise is anticipated to conclude within 4 months following the signing of the sale and purchase agreement. In a separate filing, Pos Malaysia announced it remained in the red in the first quarter of FY 2024, though it narrowed its net loss to 19.69 million ringgit, down 28.8% from 27.7 million ringgit a year ago. The improvement was driven by higher top line, which edged up 2% to 491.97 million ringgit, as the group saw an increase in revenue in its postal and aviation segments. Affin Bank said its latest quarterly net profit was down 26% year-on-year on lower net interest income and other income. First quarter FY 2024 earnings stood at 110.21 million ringgit. Net interest income fell 6.6% year-on-year to 361.98 million ringgit, while non-interest income surged 34% to 142.56 million ringgit. The lender remains focused on expanding its current account savings account or CASA franchise and high-margin businesses while optimizing costs under its Accelerate 2028 plan. During the first quarter of FY 2024, Affin's total loans, advances and financing grew by 11.2% year-on-year to 68 billion ringgit, contributed mainly by a 15% growth in the community banking segment. Housing loans grew by 15.2%, auto finance loans rose by 10.3%, while CASA deposits totaled 17.9 billion ringgit as customer deposits rose 8.9% to 71.8 billion ringgit. President and Group CEO Datuk Wan Razli Abdullah Wan Ali noted that Affin's high-margin businesses have also shown growth, particularly in the personal financing segment that expanded 27.1% year-on-year to 6.1 billion ringgit. The credit card segment rose 23.4% to 461.5 million ringgit. Gross impaired loans stood at 1.96%, while loan loss coverage declined to 102.33%. Affin's Common Equity Tier 1 capital ratio stood at 13.44%. Its liquidity coverage ratio was 162.77% in the first quarter of FY 2024, well above the regulatory requirement of 100%.